Hi everyone. Today's topic we will talk about preferred and the common stocks. As you know, Warren Buffett is one of the richest guy on earth. What he's doing for a living is to invest in the stocks. So in order to become just like Warren Buffett, you need to be able to know how to value the stocks. So objective for this chapter, you will learn the feature of not only preferred stock but also the feature of common stock, and to know how to value those securities. So the principle that related to this chapter is principle 1, right? TVOM. Principle 2, risk and return trade-off. Principle 3, cash flow are the source of the value. Principle 4, market efficiency. Principle 5, individual response to incentive. So this chapter will concern the second task of the CFO is how can the firm raise the capital. You have choice. Last time we mentioned bond, right? This time we will talk about preferred stock and the common stocks, which is what also the right hand side of the balance sheet, as you can see, right? So this time we're not dealing with long-term debt anymore. We will go below long-term debt, which is shareholders equity, right? In shareholders equity we have preferred stock and common stock. So let's compare and contrast between debt and equity, right? So debt, you have fixed claim, claim of the coupon, okay? And equity, let's do claim. Maybe you receive common stock dividend, which is very or depends on management decision, okay? Mostly from the performance. Debt, you see tax deductible because interest is deducted before you pay tax. And equity are not tax deductible, right? So you pay tax before you pay dividend to common stocks. High priority in financial troubles, in terms of debt, you will get claim of liquidated asset before the common stocks. Debt, we have fixed maturity, right? You have maturity for debt, but infinite life for the common stocks, unless you sell in the stock market. No management control for debt, right? You just the creditor. But if you are equity holder or common stock holder, you manage or you control the firm. Depends on how many shares you have. And then we will talk about the hybrid security, right? Or the combination between debt and equity, like preferred stocks, right? Preferred stock. So let's start out with the preferred stocks. Preferred stock is like a common stock. It share the same characteristic. Why? No fixed maturity. You receive preferred stock dividend forever. So technically it's part of equity. And it also like debt because preferred dividend are fixed. Okay, you got to pay just like coupon, right? But sometimes if the firm doesn't have cash to pay preferred stock, they can skip it, and it will be accumulated to the next period. So you need to pay the maybe double preferred stock dividend, right? After you skip it. Usually so for $25, $50, $100 per share in US. Dividends are fixed either as dollar amount or percentage of par value okay? Example, Xerox issue 75 million of 8.25% preferred stock at $50 per share. So preferred stock dividend will be 8.25% of 50, okay? Of 50, so you get $4.125 fixed every period, okay? Well, when to issue preferred stock, so if the company, sometimes they already has, too much debt already, so they cannot issue more debt, right? And they also don't want to dilute the ownership interest. So what else can they do? They might look for preferred stock, okay? Preferred stock had multiple classes, right? And priority lower than debt. Priority what? Priority in terms of claim of operating income or EBIT, okay? PIK prefer is pay in kind prefers, right? It's like sometimes the firm doesn't have cash to pay preferred stock. They can instead pay as what? More preferred stock dividend. Okay. Retirement, most preferred are callable. Callable means, again, the firm can give back the investor principal before maturity, right? In terms of preferred stock, there is no maturity. So the company can give back the principal before any time, right? Before infinite life. And in order to call preferred stock, the firm need to set aside part of the money every year into the sinking fund, right? In order to call the preferred stock. Now, after you know the feature of preferred stock, next step, you need to know how to value preferred stock. Why do we need to value the preferred stock? Because you need to make investment decision. If you're about to buy preferred stock, okay, you need to find, again, what we call intrinsic value, okay, the value that you believe it should be. And once you get intrinsic value, you have to compare with the market value to make investment decision. If intrinsic value is more than market value, is called undervalue preferred stock, and you should buy it, and vice versa. Okay. So how do you find intrinsic value for preferred stock? Again, you have to find net present value of what? Of expected cash flow that you're about to receive from preferred stock investing, and then you discount those expected cash flow by using required rate of return. How many percent do you require by preferred stock investing? And you got the valuation equation, right? Intrinsic value equal to a summation of discount or expected cash flow, okay, by using what? Discount rate, okay, or required rate of return. So look at required rate of return for preferred stock. It should be higher than required rate of return for bond. Why? Because higher risk premium, higher risk premium for preferred stock, okay. So interest rate should be higher. Preferred stock is riskier compared to bond. Why? Who get claim of EBIT first? Bondholder get claim of EBIT first, and preferred stock later. So preferred stockholder supposed to take higher risk compared to bondholders. What should be your expected cash flow for preferred stock? Of course, it's preferred stock dividend. Okay. Preferred stock dividend, again, as I mentioned earlier, it can be the fixed dollar amount or percentage based on par value. And you have to discount those expected cash flow of preferred stock dividend. The thing is, you look at the TVM equation, you will get what? You have to find PV, right? So PV will be equals to what? PMT, right? PVIFA given I and N. But if N get very large, because N goes infinite, right? So this one become 0. So you get the formula for PV or intrinsic value for preferred stock equals to what? Preferred stock dividend divided by I, or your required rate of return. Okay. Example: Xerox preferred pays an 8.25% dividend on $50 par value. Suppose our required rate of return on Xerox preferred is 9.5%. So intrinsic value will be, you take 4.125. How do you get this number? 8.25% of $50 par divided by 9.5%. So intrinsic value is 43.42. If the market value is 30, so this one is undervalue and you should buy, right? So here again, right, if you want to know how many percent rate of return for your investment, you need to find K, PS preferred stock. It's like what? If you buy preferred stock right now at P0 and hold it until infinity, right, infinite life, and you expect to receive D as your preferred stock dividend forever, how many percent rate of return you get? That is KPS. So if we know preferred stock price is 40 and preferred dividend is 4.125, so what should be expected return? Very easy. You take D divided by P, right? So you get 10.31% rate of return.